Hello fellow option traders, this is Jeff, and in this video I'm going to do a deep dive on the RUT, or the Russell 2000 Cash Index Calendar insurance policy that I had opened, well, a while back. Let's put it that way. So back in March, 25th of March, I opened up this double calendar, and I've opened a 910 put calendar at 693 and a 955 put calendar for $8.55. So that was going to be my insurance policy for a down market. Alright, so let me just show you something here. Okay, so let's go back just briefly in history here and take a look at the chart on 325. This is when I bought the 955 and the 910 calendar at these levels. 955 was up here, 910 was down here, and that was on 325. Then on 417, I sold the 955 because I figured, well, you know, we're headed down, and the 910 calendar was doing much better at that time in retrospect. So that's water over dam. That's all gone, and that now is currently history. So what I wanted to do was kind of do a deep dive on what I'm thinking of as a possible strategy, which I would like your feedback on what you think about it, whether I should do it or not. And I'm not going to give really an opinion at this time of what I think I should do, but I would like your opinion. We got a couple of days, trading days yet, before I think I really need to do anything about this. Because, as you can see here, I have a May expiration coming up. On the shorts, so we could just let them expire worthless, or should we do something Monday or Tuesday, or should we just close the thing out, or what should we do? Okay. So if we go over to the Analyze tab, this is what it would look like right now had I not bailed on that 955. The whole trade right now would be up $407. So I bailed on the 955 back when price was down around 910 or 900, somewhere around there, which made a lot of sense at that time. However, in retrospect, I won't do this again, but I will be, if I open up a double calendar, I'm riding it to the end, because there was a reason for it originally. Okay, so that's water over the dam. This is the way it looks today, right now. I mean, I'll leave that on there. So right now, we are down $115 with the position that we have at the moment. Let's take a look at a little spreadsheet that I rang up here. So here we bought these two calendars, the 955 and the 910. The 955 cost $8.55, the 910 cost $6.93, and then I closed out and sold the 955 for $6. So as of 5/12, we are down $9.48 on this. Alright, so here's an assumption. Let's say that I decided to close the calendar on Monday, or based on the current prices right at this moment. Taking a look at it, it would be this trade right here, where if we would sell this, it would flatten everything out. It would we would collect $5.77 in credit, and that would bring the total loss to $3.71 or $371. Okay, So let's say that I have to make an assumption here. So let's assume that assume the price is the same and I sell the calendar on 5/17, which is expiration this Friday, or that it just expires totally useless. So I would take approximately another $80 or $70 or so in loss, and the loss would be down to $4.49. That's if I let it run up until Friday, when the short will be worth, say, nothing, and I still have the long June, and if I would sell that. So that would leave us in this situation with a $4.49 loss. So I'm thinking, well, how can I somehow get some of this money back? Well, I could turn this into a profitable trade, but I'm a little concerned about the risk. Let's take a look at that. First, we'll take a look at what I'm talking about here. I'll uncheck that, so now we're back to where we are today. So let's say that I buy back the short at 9.10, and that would cost 40 cents. And then if I did that, that would bring me down to my new target for my break-even would be down to $9.88. And what I'm doing is I'm taking this right now, 9.48, and then I have to add this to it because I have to buy this back, so I'm adding more to my loss for 40 cents. So now we're down to $9.88. So if I was to sell a June and turn this into a June bull put spread, I would have to go to a 9.40 strike, which is currently would give me $11. So I would collect an $11 credit. The final result of the trade would be I would be up actually $1.12. But the way that I calculate it, my maximum risk is equal to the 9.88, which is up here, plus the strike spread, which is 30, minus the $1.12 extra credit that I would actually collect. So that comes out to a total risk of $38.76, which on one contract is $3,876. So I would be effectively risking $38 to make $1. That is not a good risk-reward ratio in my book. But it would make money if the Russell stays above this 940 put. That's the price level that I would have to do this at. Let's take a look. I welcome anybody to work this math out. If you want to, that's fine with me. That's the way I worked it out. I went over it about 3 times this morning, and I think I got it right. Okay, so we would buy this back for 40 cents, buy the May 9/10 put back for 40 cents, and then we would sell the June 940 for $11. And that would give us a bull put credit spread with a short at 940 and a long at 910. Now, when I bring this up here and I show these actual trades in here, it gets all hosed up. So in order to take a look at it cleanly, I have to do this. So I shut everything off, and this is effectively what I end up with is a 940, 910 credit spread with a 30 point spread in the strikes. And it's showing here that it could be worth $515 with a $2,485 risk, but that's not based on the history of this RUT trade, and I'm adding everything into here. My risk is much greater, and my gain is much smaller. So, okay, but I wanted to look at this from a probability perspective. because I have my date set up here to June 22nd, which is the Saturday after expiration, and it's showing me right now that one standard deviation would put me back down to 918 and back into a losing trade to the tune of like a lot, $1,600 maybe, with all the loss that I have before. We're talking $16, and maybe add another $9 to that. So this would be, instead of a $1,600 loss, this would be a $2,700 loss if it would move down. Of course, if it moves up, yay. If it keeps marching up, that's great. But if it decides that it's run out of gas and it wants to rest and lays down for a while, we could really be hurting. So where is this level? 940. Let's take a look at the chart. 940 is right here. Not sure how comfortable I feel about that. I definitely am not going to be doing anything with this trade at this time. But it's interesting to take a look and see. The Russell would have to stay above this line all the way into this expiration period in order for me to collect my $100. Well, that's a lot. That seems to be a lot of risk to me. I'd like to get your opinion on it. Now, I hope that I didn't confuse you too much. Too much jumping around. We can go back over this again and actually take a look at what I have down here for the prices. But again, I entered this back in March and closed half of it in April, and right now it's down $9.48. If I was to close the calendar right now, which is down here, this is closing the calendar, I would get $5.77 theoretically if I was to sell that. So that would bring my loss to $3.71. Or I could hold it until Friday and see what happens, and then my loss would be down to $4.49. And that, I stepped this forward doing that, using the tool down here to step the dates forward, keeping the price where it's at. I go up to the 17th. Let's uncheck this and let's check that. So I extrapolated where it would be right here for $192 loss, and I put that into my calculation. So basically adding like another X amount of cents onto this loss. 193 minus 115 is the way that I calculated it. So I added 78 cents into this loss. Alright, so I could do that, wait till Friday, or do this credit spread by rolling the 910, May 910 into a June 940. So I would buy to close the May 910 and sell to open the June 940, and I would collect $11 theoretically. And if we take a look at June 940, if I was to sell it, I might be able to get $11 for it. So that's where we're at with this. Your comments are welcome. If you want to, I'm going to post this on my blog too, so things will be a little bit more static, and you can look at the pictures yourself and see if your math comes out the same. And it's good to work these things out rather than just trust the risk profile, because you can see how it gets hosed up. If I say, well, I want to roll this into that one, and you can see that it's saying, well, you need to the price needs to actually move up in order for you to make money. Well, no, it can actually stay where it's at. As long as it stays above 940 by expiration, we would be just fine. So you can, if you just trusted the risk profile, you wouldn't really get the truth out of it. And some people can't handle the truth, as they say. So it's good to work these out manually. Took me a little while. My brain kind of felt like scrambled eggs this morning when I was working on this, but I was able to work it out, checked it over, and this is actually doing this video. It's like the 4th time I'm checking this over, and it still looks right to me. Any comments would be greatly appreciated. I'm going to cut this thing off right now, and I'll work on the post on my blog. Thanks for watching. Have a great day, and happy trading.